Today, I'm chatting with Gareth Soloway from InTheMoneyStocks.com. We talk about how companies are raising money for NFT projects despite it being a risk-off environment. We talk about the Fed's upcoming interest rate policy decision. And if you tune into the very end, Gareth has some interesting trade ideas for you. All right, everyone, enjoy the interview. Gareth, thanks for coming back.
Hey, thank you for having me back. Great to be here.
So we were chatting pre-roll here, and I was about to bring something up, and I said, "Okay, let's just do this live and get your reaction here." So this morning, as I do every morning, I just comb through media, reading. I probably read over 100 articles every morning. One of the stories that caught my eye this morning is there's been two companies raise tremendous amounts of money in the NFT space. One is actually going to burn diamonds and destroy them and then sell them as NFTs. And the other one is a company called Doodles, which is somehow related to Reddit, I think. They just raised $54 million at a $704 million valuation. What do you think's happening here? Do you think that I know that yesterday we got this huge inflation print and the yield curve's telling us that interest rates are going to go up. But do you think that this is still a risk-on environment?
Yeah, I think that there's still pockets of risk on. And by the way, one of the things that tells me is that the market hasn't bottomed yet. When you still see that kind of stuff going on, it tells you that you don't have absolute fear and panic yet in the NFT world, in the crypto world, in the stock market. And so I think that for the most part, it shows that there's still intrigue in the NFT world, but ultimately we still haven't hit bottom.
Have you ever taken the NFT world seriously? Like when I see these headlines and I see, Justin Bieber buys an NFT for $3 million, and that wasn't the actual number, but he did pay a lot for an NFT. There's always two sides to a transaction, right? And to be clear, I'm not accusing Justin Bieber of anything, but for all we know, Justin Bieber sold it to himself for $3 million, an
Right.
NFT that he created. That's why I roll my eyes whenever I see any of these headlines. What's your take on the NFT world? Do you think that this is actually a real liquid market, or do you think that there's just a ton of what we call wash trading going on?
Yeah, so that's kind of where I'm leaning to. And it's not to say that the NFT world can't mature into that quality market, but right now it's such an illiquid market, and you get so many of these type of things where people launch NFTs, then they arrange for other people to pay this price, and then the public doesn't know about it, and then a lot of pumping goes on, and then those people end up selling it for even higher, and it's just too much of a shady. It kind of reminds me of like the Wolf of Wall Street 1980s kind of shadiness that was going on there, where it was a lot of pump and dumps going on. And so I think there's quality there in certain ways. I just don't think for an average investor there's enough knowledge about it to make good informed decisions.
Mm-hmm. Okay, so yesterday we had the Bureau of Labor Statistics come out with the inflation print, the CPI print. Markets were surprised by the number, came in higher than expected. Then we had yields increase. Right now, this seems to be changing every minute, but Fed Watch tool has us at a 30% probability of a 100 basis point hike in the next hike announcement. How do you play this? Do you position yourself going into a rate hike, or do you typically wait until it gets announced and then trade it?
Yeah, so I think you base it on how the market's trading into it, right? So for me as a swing trader, I'm going to look to see, is there a ridiculously overbought scenario going into an announcement or oversold? One of the interesting things about the CPI print yesterday is you had 4 up days in a row of big magnitude on the S&P going into that print. And I think we were up I think it was like 6% on the S&P in 4 days going into the CPI number. The idea being is everyone was saying, oh, the number's going to come down, the market's going to love it. So investors were buying into that. Anytime you see that, it's a very easy scenario to see a market that gets disappointed. And that's exactly what we saw. And again, I was even surprised by how massively the CPI number came in terms of being higher than expected. But I think that overall, going into the rate hike potential next week, I'm in the camp now probably for a 75 basis point hike. I know the 100 camp is there. They're fighting. They're 30% chance of it. But I think people are forgetting that the Fed is now doing QT, right? Quantitative tightening that started September 1st. And so just by doing a 75 basis point hike with quantitative tightening also going on, it's probably the equivalent of 100 basis points. So just keep that in mind, everyone, that they are doing that quantitative tightening starting in September here. And so that's automatically tightening rates even without them raising rates. So you have to add that into the equation.
So let's talk about meme stocks for a minute here. I know that GameStop started to kick back up. Maybe it was last week. But when we sort of look at the big picture here, it really did appear that meme stocks were sort of more of a COVID thing. Everybody was sitting at home, kind of bored, playing with somehow options on apps, which we can't do in Canada. At least our robo-advisors don't allow that. Do you think that the meme stock craze is over, or do you think it's just going to find its way to resurface in different forms moving forward?
I think at least in the bear market, it's over, right? I mean, in the next bull market, there'll be some other kind of meme craze. It just won't be necessarily GameStop or AMC. But I think what's important to recognize is that individual investors, these retail investors who are trying to run these things, they try to recreate the magic from 2021. What they're not realizing is that it's not 2021 anymore, right? You don't have massive money printing by the Federal Reserve. Like you said, you don't have people sitting at home all behind their computers. You don't have the government here in the US sending out checks to Americans that they were just then putting in these stocks to run them up. And so these type of things are not going on anymore. So it's very, very hard to run up the meme stocks again in the same manner. Now, it's not to say they can't have bounces and pops, but to see them have those crazy moves of 2021, it's just not going to happen in this market. In addition, keep in mind that there were lots of people that got burned on the way down after those big runs. And so when those people kind of see the run starting and jump in, they're not going to wait for it to, for GameStop to go to $1,000 like people used to say it was going to do. They're going to say, all right, I'm up 25%. Let's just bank it and get on with it, right? So you have this kind of conditioning, psychological conditioning, where once people get burned, they're not going to let themselves get burned again because they remember that pain that they went through. And that creates a selling pressure much quicker than in the 2021 period.
Do you think that GameStop was just sort of like the perfect storm where we just had retail investors realize that they could bully big institutional funds, the big money, and then we saw the stock pop massively, and then we just saw these other names where people were trying to do the same things and didn't quite fully. I know AMC had a little bit of a run there, and a couple of other names have too. And then we had, of course, Bed Bath & Beyond a few weeks ago. But do you think that retail investors are just going to start to realize that each of these runs that happen are short-lived and we're just never going to have that GameStop moment again? Or do you think that could eventually happen again?
Yeah, so I do think that it was kind of a perfect storm, right? With everything that was going on with the printing of money, low interest rates, which made borrowing money very, very cheap, the government again sending out checks. So it was that perfect kind of situation compiled with these forums like Wall Street Bets, where people were home because of COVID. And so what were they doing? They were online, just on these forums, and it created this massive opportunity. You add in these high short ratios on these stocks, hedge funds being short, and it just really was that perfect recipe. So it's not to say it's not going to happen again. I mean, you could go back to the .com era. It was very, very similar with these type of crazy, crazy runs, but it's something that is unique to a specific period of a bull cycle. And we're no longer in that. And the Fed has made sure of that, right? We're no longer in this bull cycle because the Fed is drastically trying to curb inflation.
Mm-hmm. So, Gareth, do you have any trade ideas you can share with us? Any charts that you find really interesting that you can maybe give our audience some insights into?
Yeah, sure. So I'll just give you guys some of the ones that I'm kind of paying attention to. I'll show my charts here. So right now I have the GameStop chart up, and you can see the crazy run back in 2021. And then kind of every pop has been a little lower, which is that psychological nature of investors to say, oh, I don't want to wait around too long and get caught holding the bag. So I'm going to sell a little bit lower. But so what I'm doing in this environment is being super, super careful, right? It's a very risk adverse environment. I'm looking for high quality names that are discounted, that pay like a good dividend. And again, it's not a small cap, but I do want to mention here, like GSK is one of my favorites right now. If you look at this chart, it fell off a cliff down from like $45 in the last month or so down to about $31.28. And this pays about a 7+% dividend. So, for me, I look at this and I say, okay, you're at this beautiful double bottom support right from over here in 2020, the 2020 lows. So I know I have technical support. In addition, it's down and it's oversold. It pays that dividend of 7%. So I have like a cushion of 7% in case it still drops more. Those are the types of things I'm looking for. I also think there are some other opportunities out there, like a WBD is kind of interesting to me, where you have this Warner Brothers Discovery. We know HBO Max merged with Discovery. This stock is trading at the dead bottoms at this point, way down here. It's not something that's a no-brainer. There's some risk involved there, but I like buying stocks that I view as a discount, especially in a bear market, because you never want to pay up in a bear market. In a bull market, you pay up, you might make money just because it's continuing to go higher. But in a bear market, very, very tricky to do these type of things. And then I would just say, lastly, you look at a stock like Meta, it's just breaking support here. So it is starting to break down, but there will be opportunities. Like there's a good pivot low here from the March 2020 lows of COVID around 138. So if it dumps in the next few days into like 138, then I'm going to look to start to accumulate that as well. So for the most part, you have to be really careful in bear markets with small caps because liquidity can get sucked out. And then you kind of get stuck holding it there and holding it and holding it. And one seller can really crush it. So for me, it's kind of looking for those quality names, but that are seriously discounted at this point.
Yeah, I know that too well when the small caps go no bid, and the term that I must say to my various colleagues, partners that I invest alongside is structural bag holder. A stock might trade at say 30 cents, but it doesn't really trade at 30 cents if there's no way for you to get out there.
Right.
So
That's where volume comes in, and then actually your own share size. And these are issues that I ran into in my early career. I traded a lot of small caps, and I'd get in on a stock and I'd buy. I wasn't paying attention to how much volume there was or how much liquidity on the level 2, and I'd buy like 20,000 shares, and then I'd be up 5 cents. I'd be like, oh, this is a nice little gain on this penny stock. And then it's like, wait a minute, but if I sell, there's only 1,000 shares at 18 cents, and before you know it, just getting out, you end up taking a loss, and it's a horrendous situation.
So Gareth, for our audience, if they want to find out more of your commentary, where can they go to?
Twitter's the best place. Follow me on Twitter at Gareth Soloway. If you're interested in actual stock picks, inthemoneystocks.com is where I'm at there, or crypto, it's verifiedinvestingcrypto.com.
Awesome. Thanks so much for joining us today, Gareth.
My pleasure, Steve. Thank you so much.
Thanks so much for watching. And if you haven't already, please hit the like button, subscribe, and ring that notification bell, and let us know what you think in the comment section. All right. Thank you, everybody.